2020 was a year like no other, but we saw a strong recovery in half two and continued to deliver against our strategy, despite the challenges posed by COVID-19. Full year volumes fell by 7% to just over 9.6 billion litres, with unit margins increasing by 1%. This was supported by a bounce back in the second half, driven by the reopening of our markets, with half two gross cash profit and adjusted EBITDA slightly ahead of half two 2019. This led to a full adjusted EBITDA of $360 million, 16% lower than 2019. This recovery was supported by a net addition of over 100 new service stations in the year, which helped to increase our market share in our key markets. Our retail network is now over 2,300 sites across 23 countries, and we expect to grow by between 90 to 110 sites in 2021. The pandemic created a number of challenges in our markets, but we rose to each of these. We adapted our service stations, our depots, and our offices to make them safe and secure. We invested $4 million in over 130 projects to support our communities and host governments. And we protected our employees' jobs as well as those of our dealers and transporters. We're also looking to do more on sustainability and are formally embedding climate change into our long-term strategy. We are particularly proud of our first commercial solar contract, which will provide a hybrid energy solution to a West African gold mine and significantly reduce their emissions. The board was also pleased to recommend a final dividend of 3.8 cents, demonstrating our commitment to our progressive dividend policy, having recently paid an interim dividend of 2.7 cents in place of the withdrawn 2019 final dividend. We have started 2021 well, as the trends from the second half of 2020 continue, and we have growing confidence in the future. We are focused on continuing to capture the growth opportunity that exists within our markets, and believe that at the same time, the level of cash flow and our balance sheet flexibility means that we are able to support a higher level of shareholder returns. Therefore, we believe that now is the right time to increase the minimum payout ratio to 50% of net income and intend for future dividends to grow in line with earnings.
The rebound in the second half demonstrated that fuel remains an integral part of life in Africa, and we're excited and confident about the future opportunities that lie ahead.